Yeah, here again, hello to everybody. And here's again a chapter of General Introduction to Tax Law from the Boring Lectures channel from Kleve. You are already, I hope, used to that. Don't forget, by the way, to subscribe to this channel and press the bell that you are always be notified if there is a new video on top. And today, let's talk about Chapter 5 of General Introduction, the special rules for the taxation of income from capital and taxation of shares in capital companies. So let's just start. You will find in many states worldwide specific rules for income from capital investments. So interest from a bank account or dividends from shares in a company, if it is traded in the stock exchange or not, if you have held it privately, that usually does not play a role. In 2009 in Germany, there has been a major reform of the rules for the taxation of income from capital. And since that time, there has been a special regime for income from capital. Now, capital income is taxed separately from the other types of income. So you have heard that there are 7 types. In principle, they are all added up during the year. So your total taxable income is the result of all your profits and surpluses which you achieved within these 7 types of income. But nowadays there is one single exception, that is the result from income from capital. That is now removed from that calculation and shifted to a separate calculation. So your regular income tax only is computed on the basis of the 6 remaining types of income, and income from capital is just put aside and taxed separately. So never include income from capital into a regular worldwide income calculation if you have to do with German tax law, at least as long as this system is upheld, and probably it will still be held up for a longer time. The next peculiarity is now this income from capital is no longer taxed with a progressive rate. So it does no longer take into consideration the personal situation of the taxpayer. Are you very rich? Are you a bit rich? Are you poor? No, everybody and every single income from capital is taxed with a constant rate, a flat rate of 25%. You can find that in section 32D, paragraph 1, ESTG. By the way, let's talk a bit about the why. Why is it done? Well, in former times, we had a claim that income from capital should be regularly taxed. So everybody had to pay the full income tax on interest income and on income from dividends. Now, especially with income from interest from banks, there was a kind of a widespread sport in the population. That sport was called tax fraud. Nearly nobody, according to rumors at least, or to worst case fantasies, nearly nobody honestly declared his or her income from capital. I remember that when approximately at the year 2000, I sat together with some friends from school, former friends from school. Naturally, we met after some time, after we left school. And then talk went to paying income on interest. And I really admitted that I declared and taxed my interest income. The other 3 or 4 on the table were absolutely shocked. I tried to excuse myself. Well, it's my business. So they would not tolerate me, if they could catch me. I can understand if everybody else, as a common sense person, does not pay income tax on interest, but commits tax fraud. So it's not a moral question. It's just my peculiar, special, personal situation. I got no tolerance. They nearly shouted me down, and I had to pretend that naturally, also with my case, not everything was okay, because otherwise they would probably either have beaten me or left me alone. So if at these times you admitted to be honest concerning payment of the taxes on your interest income, that was nearly a social scandal, or everybody believed you were lying, just pretending. So unfortunately, they must have seen that I told the truth, and the reactions were rather vivid. Yeah, so from that you can draw your conclusions. Probably somebody who taxed privately received income from interest before the reform was probably regarded by all neighbors and acquaintances as perhaps insane. Good. So now they try to enforce the tax honesty in that sector by some drastic surveillance measures. For example, the banks were then obliged to communicate all interest payments to private persons to the fiscal offices. And so in the future, it was no longer possible to hide the money from the fiscal authorities, which you got from a bank account. Now, naturally, the transition was a bit difficult. And so in order to avoid a revolution, they promised the people, okay, now everybody has to pay, but don't worry, we do you some good. We reduce the rate to 25% for those people who have income from capital so that you can get used to it. And there was also another reason. They had observed during the years before that income from capital is relatively mobile. And if you move to another state, your income from capital will afterwards no longer be taxed in Germany, but in the rest of the world where you now live. So it can easily be avoided. The richer you are, the more easy you can afford to move to another state and buy a villa there. For you and me, it's a great change. For a multimillionaire, it does play nearly no role where the security details which guard him do not allow his children to play with the children in the neighborhood. So probably where they live does not play a role, so they react to tax circumstances, and one had the idea it's probably better that we claim and get 25% than that we claim 45% and get nothing, because the people move abroad and this way legally escape German taxation. So these were reasons why such a reform was made. And so since then, you get a reduced rate of a fixed amount of 25% on the income since then. Peculiarities were also introduced for the computation of income from capital. Officially, it's still a surplus income type, so the tax base is still listed as being the surplus of revenue minus expense in 2.2 number 2 ESTG. But now there is one sentence added. When it comes to income from capital, expense may not be deducted. So the formula is now revenue minus taxable is the surplus of revenue minus expense plus there will be no expense. So now the revenue is taxed. 25% is just levied on the revenue. Your real expense, if there were something connected with your interest or dividend income, is not deductible. Only for historical reasons, there is a tax-free amount of 801 euro. In former times, that was a free allowance. And when they turned to the new system, they wanted to keep that free allowance. And then just for reasons of convenience, they then just renamed it into a lump sum for deductible expense. So to cover a bit the brutality of that expense was absolutely not taken into account. The justification is probably that a private person who invests usually does not need to take up money and then invest, so credit financing is not usual and necessary in that area. So they said private persons invest the capital which they have that cannot cause great costs, and so costs are not deductible. Okay, so peculiarities also when it comes to computing. The next step was then really the big blow, or the big idea, because 25% on the revenue were now demanded, and naturally the people would have still tried to hide the money. And in order to prevent that, there was a very simple institution introduced. The banks or any other person who paid out interest or dividend income and is supposed to be able to read and write was obliged to split the payment into two parts. For example, if you have to get 100 euro from your bank as interest, the bank is obliged to split the bank transfer and to transfer 25% to your, let's call it, bank account in the fiscal administration. So they have to make a prepayment of your income tax in your name, which is called the Kapitalertragssteuer, capital income tax. So that's a compulsory prepayment for income tax from capital. Regulated in paragraphs 43 and 43a ESTG, always 25% on the gross amount which they owe you. Yeah. So when a GmbH has to pay out a dividend of 10,000 euro to somebody, if that has been decided on by the shareholders assembly, then the 10,000 cannot be transferred in one single transaction, but the 10,000 have to be split up. 2,500 are the withholding tax. At the moment, still an additional charge comes on top in Germany, the so-called solidarity surcharge, which is 5.5%, but not 5.5% of the income, but 5.5% of the income tax. So 5.5% of the 2,500 euro. That is, I believe, 137.50 euro on top. And then only the rest, 7,362.50 or so, can be transferred to your own bank account. Then you just get a certificate from the GmbH. We paid you out 10,000. Here's the attestation that we withheld the amount for the fiscal administration and the attestation to which fiscal office we transferred that. So if somebody wants to check if that really happened, they can look it up there. And that's the explanation why you only got the rest as a net amount. Now this has again an interesting effect. For every payment of interest or dividend which you get from somebody in the German inland, if that person keeps the law, then 25% are prepaid from the amount on the revenue, calculated on the revenue. Now, surprisingly, under the new rules, your income tax on that amount is exactly 25% on the revenue. So the prepayment is absolutely identical with what you in the end will owe for that amount. There are no conditions how that could change. And that explains why, under the new regime, then even an additional simplification was introduced. If the capital income tax has been correctly withheld, then you don't even need to name or to mention this event in your personal tax declaration, because the prepayment which has been made and the amount which can be kept or demanded by the fiscal administration are absolutely identical. So you can leave it out. They just then keep the money and don't bother about things. Only in cases where you get money which comes from outside Germany, there it is possible that that capital income tax of Germany is not withheld. But these are rare cases. For example, if your money ends up in a German bank account, so if a foreign person transfers in or pays interest amounts to your bank account, already your German bank is in certain situations obliged then to take the money and pay the withholding tax. But at least in situations where, for example, you get interest from somebody who lives in Paris and you collect that interest on a bank account which you have at a bank in Paris, then it's clear that capital income tax of Germany will not be withheld and prepaid for you. Then you would be bound to declare the income from capital in your income tax declaration, and then you would have to calculate that separately from the rest. Yeah? So the fiscal authorities would add up your income from the other 6 types of income and would then deal with your income from capital according to your tax declaration in the way that they compute 25% of it and demand that from you. Yeah. So this is the way how it works. This is, by the way, only the system for the type of income from capital. Now, income might also be classified otherwise, so as income from business. You remember, perhaps, there was a system, a classification system in one of the earlier chapters. There are 7 types of income and they might overlap. So there were 4 main types of income. That was the first 4 ones. And the ancillary types of income, these were the last 3 ones. And now, when one event can be classified under 2 different types of income, always the main types prevail over the ancillary types. So this is now highly abstract. Probably nobody of you has an idea of what I'm talking, so I want to illustrate that by an example. So think about a bank which receives interest income. Getting interest is, in principle, income from capital. Paragraph 20, section 1, number 7. Interest, regular interest paid from somebody without any peculiar stuff. So it could be classified under paragraph 20. On the other hand, you could also say this is money which a bank, so a business, earned during their ordinary business. So it could be classified as a part of income from business. And now the classification as income from business prevails because that's the main type of income. Yeah, and now when it is income from business, then it's a natural consequence that the 25% special rate cannot be applied, because that's a special rate for income from capital. And if you did not identify it as income from capital because another type wins, then you cannot use that 25% rate. By the way, that prevalence of other types of income is usually officially stated somewhere in that ancillary type of income rules. Here, for example, when it comes to capital income, in 20, paragraph 8, you find an official confirmation that if another classification of income from capital is possible, that this then prevails. Yeah, the 25% rate is a simplification for the taxpayer and a kind of a consolation for the fact that now you can't escape tax anymore. It's now easier to control that taxation happens correctly, because now when you inspect a bank, you just need to check what the bank paid as interest. Then if they fulfilled their duty to withhold the capital income tax, and then you don't need to bother about the recipient's taxation, because that is automatically then correct. Apart from the cases where a recipient received that money within the category income from business, but people who have income from business have a bookkeeping. So there they can't hide their bank accounts so easily, and there they can't hide the interest income. So there it will be found by the tax inspection, which inspects the book of the business. So the tax fraud risk is enormously reduced in that area. Good. Yeah, and here on that slide, there is a reminder to the fact why the 25% were introduced. You wanted to avoid that people leave the country in order to legally escape the taxation of capital. For example, Monaco, you know, that little princedom, principality lying to the south of France, where all the rich and influential people live or want to live. That's so attractive because they have no income tax for private persons. And so the idea was, if we have a reduced rate for the rich, then a few, or at least most of the rich, stay at home. Whereas if you can save 45% of your annual income just by moving to a sunny place where prominent and influential people can be met every day, well, that might be a temptation. That's not sheer theory. In former times, when we still claimed 45% or so on, so the regular rate on income from capital, a very rich German, how do we call him? It was Mr. Flick. Very rich German investor or shareholder or capital holder decided to move to Austria, because the Austrians at that time already had a 25% solution. So by shifting his residence to Austria, he could lower his income tax on all his dividend and interest income from 45% previously in Germany to 25% in Austria. Now Austria even has the same language, German. And so he moved there, and he took with him private property of an estimated 4 billion, I believe, 4 Milliarden, so milliards. The word billion is now the American use. 4 billion euro. So that was a mass of money, and that woke up our fiscal ministry, and they thought about that solution. Yeah. Now the 25% rate was designed as a kind of a bargain to the taxpayer. A good deal. Hey, we tax you now, but now it's only 25%, not 30, not 45. There is no need to commit tax fraud anymore, and no chance, and be happy. Now you are lowly taxed and no longer with 45 or 40%. But now, naturally, you know, we are Germans, they always analyze also the remote and rare constellations. And it took only a very short time till a hand rose up and somebody said, but what if a poor little widow sitting in an armchair before the fire in winter and living from small dividend incomes and interest incomes, if she is now taxed with 25%, although her regular rate would be lower? Well, there are different answers to that. The first one is, well, there are, I believe, genuinely not many poor little old widows who are sitting in an armchair, old and weak, and have to live from a poor income which is financed from dividends and interest. Because that usually requires that you are rich and have some property. But indeed, the case might exist. Let's not debate about that. And in order to be always on the safe side, the legislator just said, okay, let's avoid criticism on that. We give the people an option to opt for the regular tax rate and the inclusion of income from capital into the other types of income, so into the computation of the total taxable income. That must be applied for, because that will only be rare cases. And if you apply for that regular tax treatment, you must apply for all your income from capital. So if you then don't declare a bit of it, that would again be tax fraud, because then they also want to tax you with your regular progressive rate. So there should be no cherry picking. Either you tax all your capital income under 25%, or you tax everything at the regular rate. No intermediate solution is allowed. Well, normally when you then opt for the regular treatment, you would probably need a tax advisor to fill out the stuff. You would have to hunt down all the banks for the certificates which certify that which amounts they prepaid in your name as capital income tax, so that you get them credited and refunded if you have to pay less than 25%. That's a massive bureaucracy. If you need a tax advisor, that's also probably a bit of costs. And let me say, at least the poor little widow sitting in an armchair before the fireplace in dark and cold winter will not be able to pay for that tax advisor. But that just doesn't matter. Usually people who, for example, have a personal rate of 23% will not bother to opt to get rid of the 25% and save the 2% difference just because that's work. But now, in principle, you can do it. You can find that in 32D, paragraph or subparagraph 6 ESDG. Now, if you opt for regular treatment, you get the regular rate, but the special definition of how income from capital is computed, so that expense is not deductible, is still kept up. So you can only opt for the regular rate, the inclusion in the total taxable income. That's it. But you don't get rid of the non-deductibility of the expenses, because the idea of the legislator is still, let's go back to that. The idea of the legislator is still that private persons who have capital income do not need to have costs. You place money in a bank account, that costs no costs, which really matter apart from the fees for the bank that they administer your bank account, some euros a year or so. And probably the same with shares. That was the idea. You invest as a private investor, you invest the money which you have. You don't need to borrow it and pay interest for the capital, which you then invest in another investment opportunity. That's rather not the typical outcome, and so that is why they did it that way. Yeah. Now let's have a closer look to which income from capital may exist. You might have interest. Yeah, there we had that massive tax fraud problem before 2009. And you might have dividend income. With dividend income, it was always more difficult to hide it to the fiscal authorities, because dividend income comes from firms, and there is either in Germany, where your firm is located, either there will be a tax inspection, and if a tax inspector finds out that German GmbH or AG paid dividends, they might inform the shareholders' tax office about the dividend which were paid. So hiding dividends from a major participation is rather risky and probably no chance, never. And okay, if you have shares in a foreign company, also the foreign company will be subjected to their local tax inspection. And as all the tax inspectors of the world are good friends with each other, there is also the risk that there will be a slight, nice little notice sent from the one tax inspector to the other. So that the French tax inspector of your French Société Anonyme, from which you get a higher dividend, writes a nice letter to your German fiscal office. The guy or the girl got some 10,000 dividend income. We thought you might be interested in that. So there, the tax fraud risk is not the motive for a reduced taxation. But there is another problem. With dividend income comes from a capital company, and a capital company usually has been subjected to corporation tax. So if that enterprise made a profit of 100,000, it has already been taxed the first time, and then the money flows to you as a dividend, and then it's taxed the second time. So there is a kind of double taxation, and one wants to give a reduction so that the overall tax burden, it does not deviate too much from the tax burden of your competitors, who just are organized as sole traders and partnerships and therefore only pay income tax. So only one tax. And that is the reason why dividends also are, with good conscience, included into the mechanisms of a reduced taxation with 25% instead of the full rate of 45%. Now, dividends will also get, in contrast to interest, a special treatment if dividends end up in another type of income. So it's highly important that you as beginners are probably not yet safe in the distinctions, that you can absolutely distinguish between what's a dividend and what is an interest payment. So a dividend is paid out by a company to its owners, and the owners have given equity to that company. So dividends is the profits which you get in return for giving equity to a company, whereas interest is paid for a loan, for a credit. So not to the owners, but to creditors. And the usual distinction, if you want to distinguish equity and credit, remember please what you probably heard in Basics of Business Administration already. If you take up a credit, then this is for a limited period of time, an amount of capital. You have to pay it back according to fixed conditions. And you have to pay a prefixed remuneration. There is a formula according to which it is calculated how much you have to pay each year to your creditor, so to the person who gave you the credit. So there are due dates and there are fixed amounts. Usually the interest is computed as a percentage of the outstanding loan, so 5% or so. Whereas if you invest equity into a firm, equity is an amount of capital which the firm can keep. There is no due date for payback. You cannot enforce payback from your own capital company. Only when the company is dissolved or when it voluntarily decides to lower its capital, then you can get a payback. So no fixed payback date. And a dividend is a share in the profits, and the profits, how high they are, that cannot be known in advance. If business is running well, the profits are high, the dividends may be high. If everything goes wrong, then it might even be losses. There is no dividend at all. So equity is characterized by no fixed date of payback and no fixed claim for money for the investor. Naturally, people only give equity to a firm when they can have the reasonable expectation that in the long run they get out of that firm more than if they gave a loan. Good. And there is also another difference terminologically, which you should know, between with dividends and withdrawals. That depends on the legal form of the enterprise. A dividend is made by a juridical person. And the underlying civil law situation is before the dividend is paid, it's the profit of the company. The money does not belong to you, it belongs to the company. After the dividend has been, now I'm looking for the word and the word doesn't go by, well, not outside the window. Well, if they have determined to pay you or decided to pay you a dividend, from that moment on, then the money will be yours. So a dividend is income because it makes you richer. Money which before didn't belong to you becomes now money of yours. So dividend is income. Now, when you are a sole trader or a partner in a partnership, the situation is different, because if there are 300,000 euro in cash in the firm and you owe 1/3 of the firm, well, in a partnership you have ownership of 1/3 in every single asset and every single coin in the firm. So when there are 300,000 euro inside the firm in cash, you already owe 100,000 of them. And now if that money is paid out by the partnership to you, well, you get money which before the bank transfer was your money, and afterwards it's again your money. So you don't get richer. That's just right hand, left hand shift. So no income, no getting richer. A sole trader who makes a withdrawal of cash does not get richer. You remember, a withdrawal was treated, you have learned now, and you're probably irritated and confused. I heard withdrawals have to be treated as if the thing has been sold, yes, and gains have been realized as if the thing has been sold for the market price. Yeah, completely correct. But the book value of 100,000 in cash is 100,000. And now if you withdraw it from the firm, you have to treat the cash as sold for the market price. Now the market price of cash of 100,000 is, it's easily to guess, always 100,000. And 100,000 market price minus book value of 100,000 always leads to a gain of 0. That's the reason why a withdrawal does not make people richer if it's a withdrawal of cash. So withdrawal of a gain from a sole tradership is not income. So if we talk about dividends, and that was the reason why I gave you all that blah blah at this moment, if we talk about dividends, keep please in mind that this always only refers to profits which are paid out by capital companies to their shareholders. It's impossible that a KG, an OHG, or a sole tradership pays out a dividend. So all the special treatments in taxation about we are going to speak when it comes to dividend payments now can never apply to money which is paid out to you by your sole proprietorship, by your KG, by your OHG, by a GBR or other things. But AGs, GmbHs, and so they pay dividends. Good. Yeah. Now, dividends are also usually income from capital. That's the basic classification. You find it in section 21. By the way, if you wonder, section 20 describing income from capital and its treatment is rather long. It's not really Tolstoy's War and Peace, but it's perhaps 2 or 3 pages. So to give you a basic orientation, 21 lists the current income from capital. 22 is gains from selling the sources. So 21, number 1 is the first entry, dividends. Taxed with a flat rate of 25% because income from capital, you learned that already, is taxed basically with 25%. You have again the withholding tax, which is due if the dividend is paid by somebody in the inland, and then the final effect is again prepayment and final tax are automatically identical. So you can renounce on declaring that in your tax declaration if you do not opt for regular treatment. Yeah. Now, here again, you have that dramatic problem of the poor old widower. Now, to be fair to the genders, now it's a widower sitting in a bad mood, thinking about poverty in an armchair before an extinguished fireplace, hoping for a dividend to come so that he is able to pay for food and drink for the next month. For such a person, 25% tax rate would probably be too high, so we also allow to these people that they can opt for the regular tax tariff. But then again, naturally, all income from capital, so all interest income and all dividend income worldwide which you have, has then to be declared and taxed properly at the regular rate. You can't do a cherry picking or a selection. If they could prove to you that you left out, when you opt for regular treatment, some capital income from the tax declaration, that would be a ticket to prison. And by the way, that might really help the poor old widower sitting in a cold room before an extinguished fireplace because a prison is warm and safe. But that was definitively not the aim behind that legal rule. Now, if you opt for regular treatment of capital income, you still have the problem with the non-deductibility of the expenses related to that. And with interest income, the legislator never had an idea to tolerate that. Here also with dividends, the idea is a normal person just invests money into shares or so, which that person has. You don't borrow money and then buy shares. That is not a serious behavior. That's speculation. That's for strange people. You don't need to take that into account or to tolerate that or to change your rules for that. So usually when you opt for regular tax treatment, the expense deduction rule is upheld. Forget about expenses then. The only difference to interest income is there might be, when people buy shares, there might be business motives behind or serious professional motives which force you to, for example, borrow capital, buy shares. And then it would be hard if, for example, your profits from the dividends are 6% and you owe the bank, you had to borrow the money which was needed to finance the shares. If you also owe 6% to the bank, then in practice you would have an income of 0. And it would be hard if they taxed you on that, ignoring the expense. And it would be especially hard because economic constraints forced you to do this. So the legislator made some considerations or thought about, well, there might be some cases and constellations where people have to borrow the money and buy the shares, and then the expenses which are necessary might and should be deductible. And the legislator in Germany saw two constellations where that is convincing or can be believed. For example, if somebody owes more than 25% of the shares in a company, this is a kind of entrepreneur position. And you are not merely a capital investor, you have a major influence. With 25% or more than 25%, you can block some very important decisions by the GmbH, by the shareholder assembly. And so you have a position which is comparable to, let's say, a limited partner in a KG. You have some entrepreneurial influence. And so probably your motives for acquiring such a major participation is in all probability that you wanted to be a partner in an enterprise, partner now in inverted commas, so not in the strict sense. So you wanted to open up business, and for example, you wanted to limit the risk, so you borrowed money from a bank, let's say 100,000, then you founded a GmbH with that money, which you borrowed personally, and now you finance the 100% in your GmbH with that credit of 100,000. So in that case, legislator says you should have a possibility to deduct that expense. So they grant you the right to opt for regular, let's say, regular income calculation here, and so for the full regular treatment. If you opt, then you get rid of the 25% tax rate, and then you also get the right to calculate revenue minus expense. And now we still have the problem that dividends are always gains or profits which have already been taxed on the level of the GmbH or AG which paid them out. So the full income tax rate is regarded as too high, and so they grant you, instead of 25% special rate, another reduction of your tax your tax burden, and they just say 40% of your correctly calculated revenue minus expense, correctly calculated dividend income will be regarded as tax-free, and you only pay on 60%. So you have a tax exemption of 40% on the revenue, 3 number 40 ESTG. That's easy. Section 3 ESTG contains a list of tax-free revenue, tax-free income, and 40% of a dividend is tax-free is to be found in 3 number 40. Can't be better. 40% tax-free, 3 number 40. And now 40% of the correlating expense is then also not deductible. That is in section or paragraph 3c, section 2. The same option is also granted for people who work for a firm and had to acquire or acquired more than 1% in the firm. For example, if you are a manager and the shareholders assembly says we employ you as manager of our firm, but well, if you ruin our firm, you are not really interested in the welfare of our firm because you are an outsider, just an employee. For you, it's no risk. We want that you are in the boat. So you only get this position if you are willing to buy at least 1, 2, or 5% of the firm, because then we can be sure that you are interested in increasing the value of our shares and that you will suffer if the firm goes bankrupt. That you don't ruin our firm, then say goodbye and walk away happily to the next firm where you then begin again as a manager. So you should step into the boat and buy a participation, otherwise you don't get or you don't keep the manager job. In that case, it is clearly understood by the fiscal administration and by the law that in that case there is an income related motive, a necessity, yeah, a reasonable background for financing such a participation on credit. And so there should also be granted the possibility to deduct expenses. And yeah, so there is also such an option granted. 30D2 number 3 describes these two options. Yeah. If we now look for details on the taxation of dividend income, there are two ways how dividends might become part of a taxpayer's worldwide income. Naturally, first, they could be capital income, and the second alternative is they might be classified as a part of another type of income. Again, might be your business income or so, because capital income is ancillary type of income. So other types prevail. You can find that in paragraph 20, section 8, which explicitly says if a classification under another type of income is also possible, that other type prevails. Imagine if a participation is bought by a sole tradership for business reasons. For example, you want to buy 50% in the firm of a supplier in order to be able to exercise some control about the supplier relationship. Then your shares have been bought for business motives. They are regarded as business property, and the profits made from the shares, so the dividends paid out and the gains from selling the shares later in the future, are part of your business income. So you don't get the flat rate of 25% because it's no longer income from capital. So what can one do there? Yeah. So yeah, here again the idea must be described. Dividends are here always taxed less high than other parts of the income, because the underlying idea, we mentioned that already several times, is that dividends come from profits of a GmbH, AG, or another juridical person, let's say a limited or an SA, and have already been taxed once. So that if you add a full income tax on top, the whole matter would become far too expensive in comparison to what a sole trader or a partner of a KG or OHG has to pay. Imagine here you see an example calculation. If a GmbH makes a profit of 100, corporation tax would be deducted with 15, trade tax, let's say, also with 15, then 70 would remain. 70 could be paid out as dividend to the shareholder. Shareholder would be taxed with 45%, highest tax rate. Let's imagine shareholders rich. Then 31.5 you will have to be paid out again. And the net result from the 100 in the hands of the shareholder would remain 38.5. The sole trader could probably keep 55 or even more. So that would make a huge difference, and that would be a disadvantage, an unfair treatment of GmbHs and AGs, and that's the reason why one wants to reduce income tax on dividends in general. Germany knows two different approaches. Alternative 1, if you receive income from capital, you will usually profit from the lower rate of 25% income from capital. That's a rebate, a discount, which is nice enough to reduce that double taxation from corporation tax and income tax. Now, if you receive your dividend income outside capital income category, let's say as income from business, then the 25% are out of scope, you can't use them. Then you need to give them another reduction, and that reduction is, as I already told you, done in that way that 40% of the dividend income are declared tax-free, only the rest of 60% will be taxable. By the way, if you calculate 60% subjected to, let's say, a personal tax rate of the investor of 40%, then you end up with 24%, nearly similar to 25. Or if you are super wealthy and pay 45%, then you end up with, I believe, 45% on 60%, don't know exactly, perhaps 27 or so. So it comes very near to the reduced rate which you pay in income from capital. Good. Technically, this 40% exemption is secured or is stated in two different references, two different parts of the law. 40% of dividends are tax-free. That was 3 number 40. You remember 40% tax-free and 3 number 40. And then you must see to the fact that 40% of the related expense is also then logically not relevant because it refers to the tax-free part of the dividend. That is 3C2. Yeah. Another chapter which is necessarily combined with dividend taxation is how do you tax shares in a company if you sell them later. So shares here is meant in the more narrow sense, so not a share in a partnership. Definitively not. Only a share in a company is that what we are talking about now. So shares in a corporation, shares in a GmbH, in an AG, in an SE, shares in a stock corporation in America, shares in a limited company, shares in an SA, so Société Anonyme, or in a Société à Responsabilité Limitée, or shares in a Dutch AG. A Dutch AG would be a naamloze vennootschap, NV, or a beslotene vennootschap, the Dutch form of a GmbH, so on. Yeah? Only capital companies. They pay dividends, and that is now a share in a corporation. The basic idea is now that the taxation of profit from selling the shares should follow the same rules as the dividends which flow from the shares. That means if the shares are income from capital, you pay 25% on the dividends. You want to treat the gain from selling the shares in the same way, then you should also apply 25% rate on the gain from the sale. If shares are business property, then the dividends are business income, and 40% of the dividends should be tax-free. So also correspondingly 40% from the gain from selling the shares should be tax-free like dividends. It might be nice to repeat again when selling shares is taxable and under which rules in German law. There are 3 different constellations. First, the shares are business property. And business property is always taxable, even if you have only one single share, which you bought for business motives, then selling it will be taxable as income from business. If the shares are held as private property, then you have different constellations. Either you have owed during at least 1 second within the last 5 years before the sale 1% or more in the company, then paragraph 17 ESTG applies. Fictitiously, your gain is classified as income from business, well, because the idea is who has a major participation in the company has a kind of an entrepreneurial motive. In very remote times, decades ago, that was not 1% but 25%, and then the fiscal administration began to lower down the percentage more and more until they arrived at 1%. And later, in 2009, the remaining gap was closed for all the participations which never reached 1%. The gap was filled by 22 ESTG if you sell a single share or 10 shares in Deutsche Bank AG or in Commerzbank or in whatever, so that it's far less than 1%, then it would be taxable under the category income from capital 22. So nowadays, selling shares in a capital company in Germany is always taxable. The only difference is under which rule 3 are there from which you can select. Now, I said already, one should treat the gain from selling a share in the same way as a dividend. Now let's think about the why, because people not always understand the why. Economically, the price of a share in the market. Well, what can you do with a share? You don't treat them as a picture, hang them to the wall and admire them. If so, you would be strange. The only value of a share, it gives you a right to the future dividends of the company. So the market share of that, market price of that share, sorry, bad day today. The market price of that share is nothing else than the value of all the future dividends which are expected. Naturally, if a dividend is expected to come in 10 years, you don't pay the full price, you discount it, you make a discount for the period which you have to wait for that dividend payment. So you deduct a kind of an interest. Yeah, so the market price of a share is nothing else than the discounted present value of all expected future dividend payments. So if you need money now, you have in principle two different alternatives. First, sell the shares for the market value. Get now 1,000 euro cash on hand. Or take up a credit of 1,000 in a bank, pay interest to the bank regularly and pay back 1,000 euro credit with the inflowing dividends from the share. Then you keep the share and you just pay back the credit. And economically, if the share has been correctly valued and the interest rate by which you discounted the future dividends is the same as the bank would charge you for the credit, then both strategies should be exactly identical. And now imagine what would happen if the state began to treat the two alternatives differently. If waiting for the dividends would bring along a preferred treatment, you only pay 25% rate, or you get always a 40% part tax-free. And now imagine if you sell the shares, you would have to pay a full rate. What would be better? Well, easy answer. If I can sell my share for 1,000 and have to give 450 to the fiscal office, then I keep 550. On the other hand, if I just wait for the future dividends to come, then I only have to pay taxes on 600. Imagine the sum of all future dividends of 1,000. I have to pay income tax on 600 only. That's far lower. So probably my net income will be higher if I just don't sell the shares and take up the credit and pay it back, and I can get more money at the moment. So the effect would be, if you don't treat these two alternatives with similar tax privileges, then the effect would just be that nearly nobody sells a share anymore. They would just borrow money from a bank via credit and use the dividends which come in the future to pay back the shares. So the markets would become completely inflexible. And there would also be another influence. The shareholders would no longer be interested in rising prices for shares, because if they realize an increase in the value of the share by selling it, that would be, under tax aspect, negative. So they would insist that all money which a company makes is always paid out, and that earnings can be retained for investment. That would be very, very difficult for a firm to insist on The shareholders' assembly would vote nearly as a closed block against such a proposal. We want the money as dividends because then we get it in the tax favorable way. If you just store it within the company, that's bad because then the prices rise and we will later have to pay the gain at full rate. So you can't do that. So the only favorable idea which you have is, if you want to avoid distortions in the market, you must give the same privileges to the gains which you achieve by selling a share as the ones which you get when you wait for the future dividends. You can even prove formally that when you sell a share, that is not, or then economically you really have the same situation which you have when somebody receives a dividend. The reduction for dividends is usually justified and correctly justified by the fact that corporation tax has already lowered the money which comes to you, so that taking a full income tax on what remains would be too much. The same situation is exactly given when you sell shares, because the price of a share is the complete amount of the expected future dividends. Now, dividends are what is left over after corporation tax has been deducted from the profit. If a company gets 100 as a profit, corporation tax and trade tax need to be paid, so perhaps only 70 remain. So you can never pay out 100, you can only pay out 70. And imagine we only had 1 year, just to simplify matters, you would never pay 100 for that share. You would only pay 70, because that company can never pay out more than 70 euro to you. So you would deduct the expected corporation tax burden of the future from the expected profits which can be made from the company in the future. And so the price which you offer as a buyer of a share has already been lowered implicitly by corporation tax and the burden of the company in the future. And now the formula here says, okay, when you then, or if you then would charge a full income tax rate, then you would have a double taxation. Exactly the same situation as if you collect current dividends. And so granting the same reliefs is not only a feeling, but it's really also mathematically adequate. Only by this you reach a similar non-distortive fiscal burden for selling shares. Remember now the three different constellations which might exist and how they can be taxed. Shares, if they are business property, then the flat rate of 25% does not apply, but dividends would be declared with 40% tax-free, and 40% of the expense would be cancelled. So the parallel solution for shares is 40% of the share's price which you obtain are tax-free, 40% of the expense of the sales transaction and of the book value which you treat as expense when you book it out are non-deductible. Shares are private property and are covered by paragraph 17, then they are classified as income from business, so same solution as income from business. Shares are private property and your percentage is lower than 1%, then it's classified, the dividends would be income from capital, then the gain is also income from capital, and income from capital is taxed with a flat rate of 25%. So you see here the three different solutions. Yeah, so let's play around a bit with cases where we can practice this a bit. Here is my first case which I want to offer you. Here's a shareholder, and naturally he has the significant name of Mr. Sher Khan. lives in Paderborn in Germany and sells a share in the Samst AG. Samst AG got its name from the fact that it organizes party events for weekends. And Sher Khan bought that single share for 100 euro 2 years ago in the Frankfurt Stock Exchange, and now he got a price of 400 euro for it. So very favorable investment. How is that treated under German tax law? And that is necessarily to be found out now. How would our solution look like? Okay, let's begin with the beginning. Then the beginning is to a personal tax liability. So Sher Khan is natural person, lives in the inland Paderborn, Germany. So unlimited tax liability under 1 ESTG. We got that. No other taxpayers included in the case, so we can pass on to the events. There is only one event, a single event, sale of a single share in Samst AG. First question, is it taxable? So type of income. This is selling a share 22 ESTG. Gain is taxable as income from capital. Tax base is here surplus, but gain is defined to be the surplus. This is price 400 minus expense and cost of acquisition, because that's also expense. If you get rid of the share, you don't have it anymore. So the 100 euro which you had originally are no longer there. So that makes you poorer. The share is gone. So you only have that here as a final result. Tax rate is 25%, C 32D 1 ESTG. So here we have 300 times 25%, that's 75 euro. And that's it. Case finished. Now a second example. Here we have Mrs. May Be Rich. She owns 40% of the shares of the Risk Limited, London. She lives in Munich, Germany. And she bought the shares for 400,000 euros some years ago. And now she sells them for a price of 610,000 euro. And she has to pay fees and notary costs and lawyers and other stuff, 10,000 euro. Tax treatment under German income tax law, that's a question, and that is what we immediately have to do and solve just now. Let's begin at the beginning. Personal tax liability. May be rich, natural person, so ESTG applies. Unlimited tax liability 1 ESTG because residence in the inland Munich. Okay. First question solved. Second one, events. Sale of 40% shares in Risk Limited. Type of income. Well, more than 1% holding in a company. That was section 17.1 has to be tested. And here we have indeed shares in a capital company. Does not need to be in the inland. Everywhere counts because here we have the principle of worldwide income taxation. So it does not matter where the company is located. More than 1% participation during or at some time during last 5 years, and the answer is yes. Now, and now is during the last 5 years, so that's no problem for us. And shares have been sold, so section 17.1 applies. Calculation of the tax base. That's regulated, by the way, if you look it up in 17.2 ESTG, price minus expenses of the sale minus cost of acquisition. COA is an abbreviation which only I use, so please, if you use that in an exam or so with any other examiner, always make a list of abbreviations and explain what it means. So here that is 610,000, but times 60% only because of number 40 ESTG. So now I need a calculator. $244,000 minus 10,000, but only 60% because 40% are not deductible 3C2 ESTG. So minus 6,000 and minus 400,000, but only times 60% because 40% of the costs and also of the costs of acquisition are not deductible. 400,000. Oh my God. 400,000 times 60% is 240,000, and there is something which I do not really regard as convincing. That was a shot into the oven. I calculated the 40%. Yeah, here you can always make a plausibility test because what comes out as difference from the 100% must also be equivalent to what comes out from subtracting the 60% figures. And here we have 366 minus 6,000, so 360 minus 200, 120,000, and that fits. Okay. Now, that's our tax treatment under German income tax law. By the way, there is also a special allowance in 73 ESTG for selling shares in such a situation, and that will be perhaps debated later in a later semester. So we neglect that here because if you make really good cash from selling shares, that free allowances regularly revoked or called, that one calls that phased out, so it does not apply here in all probability, and for beginners it might be a bit complicated, so forget about this and you should know these things first here. Good. Yeah, and now a third case, and then that should be enough for that subchapter here. Now we have somebody that's Mr. Would-be Rich living in a house in Munich, Bavaria. That's in Germany for all the ones who came from China or from far away from the world or so. And Mr. Would-be Rich also has a house in San Francisco, USA. He sold shares in the example BV for 500,000 euro. Cost of acquisition of these shares was 100,000 euro. The shares have been bought because Mr. Rich is the owner of a furniture factory, and the shares were shares in the major furniture trading house. The example BV is evidently a trading house which sells furniture. So it was a business investment in order to strengthen the position of his firm in negotiations and business transactions with that trading house. Now, Mr. Rich must sell because he has made huge losses in the rest of the business. There he had 400,000, so he urgently needs money. And just to avoid complications, if somebody from a higher semester now drops in and says, I read the double taxation treaty with the US, and according to the double taxation treaty, Mr. Would-be Rich could only be taxed in America, not in Germany. Now we just say the personal situation of Mr. Rich is so that he is resident under the double taxation treaty in Germany, and that under that double taxation treaty, it shall be agreed upon by two states that Germany can levy a tax. Okay. We don't care if the DTT with the US really says that. It might be possible that it is this way. Depends on the personal situation, and we just assume it is that way. Otherwise, you would just spoil my case, and I don't let you spoil my case. What is in a case is always to regard it as proven and correct. So we are going to solve the case as it stands here. Now, so let's, taxation is regarded by some people as a boring matter, and we don't know why, but one suspicion might be founded in forget about that sentence. That was real madness. So indeed, it begins in a boring way, but we can call boredom also routine work, and that sounds far better. Personal tax liability. Would-be Rich is a natural person, so subject to income tax, is subject to unlimited tax liability under 1.1 ESD3 because he has a residence in the inland and that he has a second residence elsewhere does not change that. Even if the second residence were his primary residence, that has no influence. He is subject to the rules of unlimited tax liability. Events: selling the shares. These shares are business property. Type of income. That's our question which you want to solve, just in case that the reader doesn't understand. So we add this. These shares are business property because they have been acquired for business purposes. The need to strengthen the business position or the negotiating position of the firm in relation to the furniture trading house. So the example BV. Consequently, where is the cursor now? got killed, evidently. My cursor committed suicide. Where are you? Cursor, where are you? If that was no live session, people could call me by phone. I found it, I believe. So, next line. What does Mr. Rich have to do? Well, as it's business property, selling it is included in the computation of the business profit. Yeah. Gain from the sale is, let's have a look, 500,000, but times 60% only, C3 number 40 ESTG. So 300,000 minus book value. Here probably the cost of acquisition 100,000, but only 60%. C3, C subparagraph 2, number, no, not number 2, what nonsense. 60,000. So taxable gain 240,000 from selling the shares together with the remaining profit from business activities minus 400,000. That leads to a total profit from business this year of minus 400,000 plus 240,000. That is minus 160,000 euro. So still a loss. Okay. Case closed. Ready. There seems to be no other event in it. There are no peculiarities which we had to add under Roman figure 3. There is no data to compute the worldwide income, no data compute the whole tax. So that can't be demanded. So case is closed. Now permit me a small remark. Naturally, when you sell shares, you can also make losses. And the deductibility of losses is also and always, not always, often restricted. For example, losses which come from income from capital can only be offset against gains from capital income. So if you make a loss in the area which is usually taxed with 25% flat, you cannot deduct these losses from areas, from types of income where the income is usually taxed with 45% or 40 or 30%, because then you would end up with distortions. So in general, losses from 22 are imprisoned in that category. You can carry them forward to future years, but you cannot offset them against income from the other 6 types of income. Now, when you sell paragraph 17, participation, so 1% or more, that would be classified as income from business. So you could add it up with other types of income, because there income from business is subject to the regular tax rules. Everything from the 6 remaining types of income is added up. Special personal allowances, so special expenses and extraordinary expenses are deducted, and after some additional computations, at the end you end up with a final taxable income. And so losses would qualify there. You could deduct them. The reason for that is, well, the gains would also have been taxed with a regular income tax rate. So then it's fair that also the losses reduce that income which is taxed at the regular rates. But the deduction of the losses is subjected to several restrictions, because there might be some clever trick. You know, people always have clever ideas when it comes to taxation. You know already a loss reduces your income from other sources, and so your income tax burden goes down. And now imagine you invested in 0.99% of the shares of a corporation. That would be a 22 investment. Gains would be 25% taxable, not at the higher regular rates. Now you think a bit and think, oh my God, the whole investment in these shares is going completely wrong. When I sell them, I will lose nearly everything, so enormous losses. And when you have enormous losses, which income do you want to deduct them from? From the income which is taxable at 25% or from the income which is taxable at up to 45%? Naturally, I want to lower the income in the area which is more expensive for me. So some people would try to think about, how can I transform such a 0.99% participation into a Section 17 participation? And the answer is, well, buy some 1 or 2 additional shares so that you reach the 1% threshold. Then it's a 17 participation. Then the losses would classify for regular treatment. You could deduct them from the highly taxed parts of your income and so increase your tax saving from the losses. That was a trick which the legislator feared, and so in case of losses, there are additional restrictions which must be fulfilled before you can be allowed to deduct a 17 ESDG loss from the rest of your worldwide income. And last but not least, naturally, one thing is clear, 40% of the gains would have been tax-free. Naturally, 40% of the losses are then also tax-free, so not deductible, not relevant for tax, because the tax exemption of 40% of the revenue and the exclusion of 40% of the expense are applicable without any respect or differentiation to if it's a loss or a gain. A loss is just a gain with a negative sign in front of it. Makes no difference. So if 40% of a gain are tax-free, then also 40% of a loss do not exist, are not deductible for taxation. When you have, as in the previous case, would be rich, losses from shares which are held as business property, then they are always taxable. Then always the 40% exemption rule applies. So very often that's also called the 60-40 rule, or in German, the Teileinkünfteverfahren or partial income taxation. That is a special word which classifies that 60% taxable, 40% tax-free scheme. And naturally, then also 40% of the loss would be not deductible because it would be tax-free. Let's look to a more complicated example case just to give you some training again, how the whole thing might be integrated together and to repeat what you have learned up to now. And for many, many reasons, just here the case drops down from heaven. We have to think about it. So, Will B. Boring is a tax professor employed at the University of Kleve in Germany. Will lives in Germany and is not married. People are usually not married. That saves us the splitting tariff calculation. And childless is also very preferable because when they are childless, you don't have to deduct some children's free allowances from the income, so we don't have to bother about that. That's not really important things when you deal with the business consequences of tax law. Good. Now, what does Will Be Boring do? He has a monthly salary of, let's say, 4,000 euro. Bought some books for 120 euro. During the year, the books are for his job. Paid a fee of 200 euro as a member of an association of accountants in order to get their journal and professional information on new things going on in that field. Had travel costs for traveling to the university and back of 600 euro, and that was already correctly computed according to tax law. I mentioned to you in a previous video that travel costs, commuting costs to your place of work and backwards are standardized in order to simplify life for the fiscal administration and perhaps you. So the 600 euro are already the correct value for tax. He sold 3 shares in the SE at Frankfurt for 800 euro, which he had bought for 900 euro. He also sold a participation of 10%, which he had inherited from his old father. Price was 30,000, father's cost of acquisition 10,000. He began to write a book. For starting, he got a first prepayment of 2,000 euro, and after the book will be finished, additional 8,000 will come. The 2,000 were paid this year. He has 2 accounts in banks, a German bank account from where he got interest of 10,000 and a foreign bank account where the interest was 2,000. Special expenses and ordinary expenses 20,000 plus. A wheelchair in advance to be well prepared in case that he needs that in old age, 5,000. Sometimes I really wonder which strange ideas I had in previous years. That gives me, forget about it. It's just as it is written down here. That's the case, and that is what we have to think about. Well, so let's start this. Now, when we have to deal with a case, we have genuinely no idea what we have to do, and that's simply always the case. So we begin at the beginning and hope that at least we survive successfully the beginning. The beginning is personal tax liability, which does not surprise us. Probably we are still able to do this. Will be boring, subject to unlimited tax liability under 1.1 ESTG because residence or lives at Kleve. Good. Events. Now, bad thing, there are several events. 2.1, the job at the university. First, type of income. Income from employment. You can see that in section 19.1, number 1 ESTG. Recommendation is look it up because it's a salary for service for an employer. The tax base. Is it the profit or the surplus? And it's the surplus of revenue over expense. Section 2 to number 2. Here I just remember that I have forgotten something because we could also say, so it is part of the worldwide income under 2.1 number 4 ESTG. Yeah, so the tax base was the surplus of revenue over expense. So what we have to do now is to look for revenue and look for expense. There. Good. The salary 4,000 times 12 is 48,000 euro. Expenses. And by the way, salary is expense because it is money. And salary is expense, salary is revenue. Oh my God. That's when one is not highly concentrated. And by the way, in the exams which you are going to write or so, I also find, very often find similar slips of the pen or so. Yeah, here we have number A, books 120 euro, income related expense under section 9.1 ESDG because they were bought for the job. Necessity does play no role. The only question which we could ask is when you buy a book, then you exchange cash for a book which has a book value of 120. So you can only depreciate the book over time. Some assets which are low leveled can be depreciated immediately because value is lower than 800 euro. So minus 120 euro. That's a simplification rule in German law. Many other countries have similar rules because otherwise you would have to depreciate a book over, let's say, 20 years or so. That makes absolutely no sense, or you would have to make debates. And so and low value assets can be easily immediately depreciated if you want to, and naturally you want to. Membership in an association of accountants, job motive, so income related motive, and the answer is yes, to obtain additional professional knowledge and information about what's going on in the job. Is there a private motive, so a consume motive, which spoils the whole thing? And the answer is, oh no. So this is a deductible expense under paragraph 9.1. I believe there is even a special number for this. I believe it's number 3, but I'm not motivated. It's late in the afternoon, not motivated to look it up. Exactly number. Look it up. For professional associations, that is acknowledged as deductible expense. And travel costs, deductible under paragraph 9.1 ESDG also. So minus 600. Total revenue 48,000. Expenses is minus 120 plus 200 plus 600 is 920, but minimum amount which can be deducted is 1,000. See paragraph 9a, number 1 ESDG. There is a minimum amount of 1,000 euro, which is automatically believed to exist in all cases where somebody had a job, just to simplify life. So income from job 47,000 to 2. Selling 3 shares. 800 minus 900 is minus 100. That is 3 single shares at the stock exchange. Definitively not a 1% participation. So it's income from capital 22 ESDG. So not deductible from the rest of the worldwide income. B, or 222, selling 10% participation inherited from father, and bought evidently a long time ago. I think so. Price 30,000, and father's price, cost of acquisition 10,000, and that is just carried on. If you inherited something from, so if you got it for free without paying a price, then just the cost of acquisition of the previous owner are carried forward to you. So let's test section 17.1. It's shares in a capital company. Yes. Seems so. Okay. More than 1% held. Yes. Paragraph of 17 applies. Okay. What else? Now 17.2. Let's calculate the profit or the gain. Price minus cost of acquisition minus cost of the sale, which we don't have. So $24,000. No, 18,000. Minority views on mathematics are widespread nowadays. And cost of acquisition 10,000, but only 60% are deductible under section 3C 2 ESTG, so only 6,000. Gain is 12,000 euro. Let's make the check. 20,000 would be the difference if we calculate the 100% figures. 60% of 20,000 would be 12,000. Evidently, we are right. Yeah. Good. And the free allowance under 17.3 is ignored here for reasons of simplification. Okay. So result here is 12,000. Writing a book. Which type of income? Income from self-employment. Because paragraph 18.1 number 1 says, income from self-employment is not everything which you do independently, where you are your own employer and perhaps the only person working for yourself, but it's only certain noble, intellectual, or high-standing professions, and income as an author is a so-called free profession. Yeah, so tax base is the so part of the worldwide income. 2.1 number 3 ESTG. By the way, don't learn that by heart, just look it up. After some 10 years as a teacher on that, one knows it by heart, but you shouldn't do it as a beginner. As a beginner, turning pages in books, that keeps you slim, keeps you alive, and makes you fit in dealing with the law. So always look things up. Tax base is the profit to number 1 ESTG, and here we have business revenue of, yeah, good idea, 2,000. Taxable when they were received, 11.1 ESTG, so this year. We can suppose reasonably that somebody who is an author does not need and will not make a balance sheet and a proper bookkeeping. You can write that down, you don't need it. Okay. Business expenses None can be seen here. So profit. The additional 8,000 of next year are definitively not covered by tax liability this year. The bank accounts. German bank account. Income from capital 21.1 and plain interest from a plain bank account, no mortgages and no other games, is just income from capital. So taxed separately from the rest of the income. Tax rate 25%, 32D1 ESDG, as it is from Germany, 25%, which is here 2,500, will have been prepaid. So declaring this is no longer necessary. 43.5 ESDG confirms that. Yeah. The foreign bank account, also income from capital, not form, capital 21.1, number 7, because it's interest. Taxed separately. It's 25%, 30D1 ESDG. So 500 euro on you. As the bank is foreign, it is to be assumed that no German capital income tax has been levied up to now, so declaration in tax declaration is necessary, but separatedly from the rest of the worldwide income. Number 5. Special expenses. 20,000 are given as such. The wheelchair. Is it an extraordinary expense? And the answer is an extraordinary expense. You remember that were the totally necessary private expenses which you couldn't avoid, you could neither avoid to pay, nor you could reduce the amount. No, because the expense was not strictly necessary, could have been avoided. The idea, just let's buy a wheelchair now, we might need it in the future, then we are prepared, is a nice idea, but really not necessary. So not acceptable. So here we end up with 20,000. So probably we can now, number 3, to sum up. We have job income. There we have 47,000. Then let's look again. We had selling the shares. That was a loss which could not be accepted. Then we had the gain from paragraph 17, that was 12,000. That was 2B, let's call it 2B. Gain from paragraph 17 plus 12,000. That was that. And now let's go to number 3, the book, 2000. Income from self-employment comes first. If we arrange all this according to the sequence of the types of income, then we renumber that. No, gain, job income comes later also. So no, let's shift that up. Let's shift that up. And income from self-employment is type of income number 3, so it would be there. Now I created a perfect chaos. Because income from business would be here. That would be number 1. This would be oh my god, I hate PowerPoint. Do you also always hate PowerPoint? It's absolutely necessary to use it. It's the best invention which ever existed, but it does not really make you happy, at least not me. Income from self-employment is number 2. Works now. Income from the job is number 3. Good. The loss from capital is ignored. Let's go on. What else was in the case? We had done with this. Then we had the interest from the banks. The interest from the foreign bank is income from capital, and that was 2000. To be declared, to be dealt with separately. So total from the types of income. If I've not forgotten something, we have 47, 12,000, 59, 61,000. And plus income from capital not yet taxed, 2,000. Tax tariff has to be used, no, from the total type of income minus special expenses, etc. What has been acknowledged minus 20,000. So that leads to a total taxable income 41,000, and fiscal office will add 25% on this. So we have to look that up in the tax tariff function. And now I promise you that I just make a small break and look it up in a computer program. What would be the tax for 41,000 now this year? And that brings me to 8,681 euro in the year 2021. And that is plus 500. So the fiscal office will be boring with 8,681 plus 500, and that is 9,181 euro. And the figures are valid for income tax 2021, because this is a video which will a long time remain on YouTube, at least I hope so, and naturally in later years there will be different results coming out when you try to calculate that. Okay, That shall be enough. That case has been done, and so let's finish that now. Now, just to repeat some basic idea again, to repeat, what happens if you have some additional tax-free income? So, do you still remember how that proviso safeguarding progression did work? Because here is a small variant of our case which reminds you of that. Mr. Will Be Boring has everything as before, but now he has additional income of 300,000 tax-free from the Netherlands. What has to happen? We have to find it out, and we'll do it just now. Total taxable income, just as before. That was, what was it? Let's look it up. That was 41,000. I hope that I did it correct. You know, I'm famous for computing mistakes, but I really hope I did it correct. Now, tax rate relevant income is total taxable income plus tax-free income under proviso safeguarding progression. That's always the case with income which comes from the Netherlands. So tax rate, which is tax-free under the double taxation treaty. Sorry, tax rate relevant income is therefore 341,000. Tax for 341,000 would be, now let's look up the formula for 2021. So I looked it up just now. No, 0.45 of 341,000 minus a discount or a correcting factor for the fact that not all of the income costs 45% in total. So if we calculate that according to this formula, it comes out 153,450 minus these 17,374.99. That would be 130,075.01. And don't forget, we only made that calculation in order to determine the average tax rate, the adequate tax rate. Yeah? That would correspond to a percentage of, yeah, what? 101 divided by 341,000. That would be 39.99046% plus some digits far away at the end. This applied to a total taxable income of 41,000 would lead to a tax of 16,360.92 plus the 500 for the income from capital. Case finished. Perfect happiness, ladies and gentlemen. Let's make, yeah, and that has been again enough for today. Now I hope I have you informed a bit about the treatment of income from capital under German income tax law, and I would really greatly appreciate if you show up on this channel again in the future sometime or in the near future. And see you again soon, I hope. Thanks for watching and recover well from watching. Ciao.